Alrighty, welcome to the live stream. So we're going to go ahead and live stream the Jackson Hole 2025 Symposium. And we're going to go ahead and, just talk about the commentary before and after Jerome Powell sets the stage. Let's go ahead and actually take a look at the markets right now. By the way, just want to address the elephant in the room. If you guys are wondering, probably you're not wondering, but if you were, face is super red, just did a cosmetic procedure, beauty is pain, right? But let's go ahead and actually try to share the screen. Let's go ahead and take a look at the markets. What are the markets doing right now? So let's get the Webull platform here. Okay, so currently we had a little bit of a jump for the S&P 500. It's kind of starting to curl down a bit. We are just a few minutes away before we actually have the speech take place. Now, something that's pretty interesting is the sector rotation that we've been seeing, right? I talked about this for those that are within the Push and Profit Research Insider Group. So if we take a look, we actually had a few. It's about, let's see, 1, 2, 3, 4, 5, about 6 days consecutively that the S&P, or not the S&P 500, the Nasdaq 100 has been falling down. But when we actually take a look at RSP, right, which is the S&P 500 equally weighted, we see a different story, right? So why is this interesting to note? That's because what we're seeing is that tech is being driven down, but the overall market is actually holding up, right? And so the reason why that's pretty interesting to note is because we're pretty much just witnessing a sector rotation. So just wanted to kind of mention that, right? So let's actually see. Let's take a look while we're looking at the markets here. I'll keep it on a 5-minute chart so that everyone could just see what's going on minute by minute. But while we're looking at that, let me see if I could go ahead and find the speech, right? Let's see. Hope everyone's doing good, by the way. Hope everyone's having a good morning. Let's go ahead and see if we could find this here. Now, my predictions for Jackson Hole, right? I think that we're likely going to have a Jerome Powell that's going to likely stick to a hawkish tone, although that could actually be pretty bullish for the market if we do indeed get that cut in September, right? Actually, let's take a look here. Let's take a look here. Rate cuts. Let's see. Let's go ahead and take a look at what the future markets are pricing in. So the future markets, oh wow, it went lower, right? It was a couple weeks ago a 99% chance that we are going to get cuts in September. Then after the PPI report, right, where we kind of saw what producers were paying, and it was a bit concerning, the highest that we saw in a few years, it went down to like 86, I believe, and now we're at 73. So pretty interesting, right? It's going down. But let's go ahead. Let's go ahead and get back to the markets here. So let's take a look. I think we're going to hear Jerome Powell likely say something along the lines of tariffs, concerns, and data dependency, right? He's going to stick to his script. Let's go ahead and try to get Webull back up here so we could simultaneously look at the market. There we go. By the way, guys, I am like the worst when it comes to live streaming here. But let's go ahead. Let's see if we could get something here. Give me one moment. Should be starting up in about 1 minute. Let's see if it's over here. Nope, still hasn't started yet. Am I missing something? We should be on time, punctual. Markets are pushing up. We see the QQQ having a big bullish candle now. Let's see if we could find this though. Okay. Let's see. Nope, still nothing. Interesting. Still nothing. Okay. Should have prepared a little bit of an activity, right? If we were going to be late. I remember the first and only live stream I did on this channel was back when we had a robo event for Elon Musk. And my goodness, he was late like a whole hour. And I was not prepared for that, right? I was just not prepared for that. Let me go ahead and share the stream here on X. Make sure we get a few more people to just, join in the experience together. So let's go ahead and set that up. Wow, markets are definitely pushing up heavy here. Yeah, it still hasn't started. I'll let you guys know once it starts. I'll be quiet. Okay, I'll just go away in my little corner and I'll be quiet. So let's see here. Currently, I don't have any well, I do have positions in the portfolio, but not doing any active trades with QQQ or anything like that. No intraday trades of any sorts. Let's go ahead and try to share this here. Yeah, I'm just not sure. We are at 10:02 and we still haven't started. Come on, Jerome. Come on. Let's not be late. Come on, let's not do that. Alrighty, just posted on X as well. By the way, if you guys haven't done so already, make sure to follow on X. I am active there. Also, while we're waiting, right? While we're waiting, just started. Hold on. I will share my screen. Give me 1 second. Let me stop this. Let's go ahead and stop this.
Policy framework as captured in the revised Statement on Longer Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months.
Is he going to talk about the PPI report? Let's see.
During 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering.
Imagine being able to build an app with
come
your
on.
name on it.
I'll
just
get
by
a
thinking
different
about
one.
it.
I'll get a different
Meet
one.
Base
Yeah.
44, a complete. Describe what you.
Yeah, let me get a different one here because we don't want ads. That's crazy.
Of 2024. In contrast, housing services inflation remains on a downward trend.
All right, I'm just gonna switch it real quick just to have the live stream from Bloomberg, right? I think theirs is a little bit
likely
nicer.
to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC.
Thales is a global leader in cybersecurity, securing what matters most.
That our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a makeup strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens.
Missy just wanted
Further, they
to
allow
take a
monetary
look as
policy
well.
to
Missy,
support
you see
maximum
this?
employment in economic downturns
The market's pushing
without
up.
compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that long
Performance, durability, affordability. Only one place does it all. Harbor Freight.
It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
All right.
That
So
was Fed Chair Jerome Powell wrapping up his annual Jackson Hole remarks. What a Jackson Hole speech that was. This is Bloomberg Surveillance on television and radio, live from Jackson Hole, Wyoming. What we heard there is they are prepared to move rates lower on the heels of their dual mandate being in conflict. We see a market reaction. We could see 10-year yields are lower by 10 basis points. Two-year yields are down by 10 basis points. So 10-year yields are down by 7 basis points. What you see is a weaker dollar, stronger euro by some 0.7%, which you can see.
All right. So let's go ahead and talk about that. I'm going to go ahead and pull up the Webull charts here, so we could kind of just look at the market a bit here. So we didn't get anything that was concrete from Jerome Powell, right? Nothing saying, hey, look, we're going to go ahead and cut rates next September, right? But we did hear that they are inclined to go ahead and, perform something that would be a bit dovish, which of course is bullish for the markets. In fact, if we take a look here, if you guys were here in the beginning of the stream, then you guys remember I showed how the future markets were pricing in a 70-something% chance of cuts in September. But now we see that after this speech, we have the future markets pricing in a 91% chance that we're going to get cuts in September. So a big shift, right? Now the markets are pricing in rate cuts. So that's pretty good, right? We want the Fed to cut rates in September And we don't want them to do it before it's too late, right? We want them to do it and be proactive and not be reactive, right? There's a big difference, right? The huge difference between both is when you're reactive, that's when the economy is crumbling and you're trying to catch up. Being proactive is being ahead of the curve. And it seems like that's kind of along the lines of what Jerome Powell was saying. But let's go ahead and let's take a look at the QQQ. Oh wow, markets are still pushing up. Ooh, yeah, this is amazing. Beautiful day. Let's go ahead and take a look into that for you guys here. Let's go ahead. Missy, my cat is in the background. Just she's ecstatic. She is ecstatic. All right. So let me make myself smaller here. We see that the S&P 500 had a huge jump. If we actually take a look here, let's go to a. I'm just moving something out the way. Let's go to a daily time frame. As I mentioned during the live stream, we are actually close to new all-time highs, which is pretty interesting, right? Because we had about 5 to 6 consecutive days going downwards. Just hearing Jerome Powell go on the podium and kind of mention or allude to the idea that they're going to be proactive. We're seeing the market have this big, beautiful candle going upwards. But one of the things I did mention for those that are insiders at Push and Profit Research was that when we actually take a look, it wasn't that the overall market was going down. We were just seeing tech go down, right? Because when we look at RSP, right, which is S&P 500 equally weighted, right, we weren't seeing that, push downwards as we were with sectors like technology, right? I'm trying to remember the ticker symbol. It's XLK for technology. Technology was what was falling down. But when we actually take a look at XLV, right? Let's take a look at XLV, which is healthcare. Healthcare was actually pushing up, right? Also XLF, which is financials. Financials are pushing up. So it wasn't that the market was, so to say, falling down. It was more so that the tech sector was just having this big rotation. Let's go ahead and actually, I'm going to go ahead and see what is Bloomberg saying now, right? Let's take a look at Bloomberg TV here, see if they have anything interesting that they're saying here. Give me one moment. And I do just want to thank you guys for your patience while we go ahead.
If we get okay growth numbers, or if we get inflation that's a little bit too perky, if we get rotations in the market, I think some of the rotations in August into small cap was unwarranted in my view.
So we are sitting here after digesting that speech, and I'm going to have to go read it about 3 more times to really internalize all of the complicated messages laid out by Jerome Powell in his last speech as Fed chair. Mike, before we continue, Michael McKee here, our chief economics correspondent, can you just wrap through some of the key headlines once more so that we can really understand just how big of a policy shift in some ways this really was?
Well, it's a policy shift, but one that has been signaled for a little while, which is why the markets have been buying into it. But Powell basically accepted the market's argument that it looks like the labor market is weakening, and that is a threat to the overall economy. And inflation is rising, but it may not rise as quickly as the Fed had feared. And so therefore, the door is open to a rate cut if we get supportive data from the CPI and the employment report that we get at the beginning of September. Now, the thing about what he said today that I think is important is once you open the door like that as Fed chair, it's almost impossible to close it. It would take a lot in these data points that are coming out to change that view. And the market's going to go overwhelmingly towards the idea of a rate cut. So he's pretty much baked it in at this point. So I think what then happens is it goes to Kate's point about where we go from there. The focus will be on the other 2 meetings this year and then what you do into 2026. And I think if you ask the chairman, he would say, we don't know yet. That's the data dependent part. But for right now, we're going to give you what you think you need.
And right now, what you are seeing is almost a certainty priced in for a rate cut next month. But Kate, one other thing you're seeing is weakness in the dollar on the heels of this.
Yeah.
Do you expect that to be very much an ongoing theme? And it just kind of edifies it, given that this is taking the more dovish approach.
Yeah, we had a pause in terms of the weakening of the dollar after a really vicious weakening in the first part of this year. And I've heard a lot of currency strategists say, say, we're going to tread water for a little bit. We've made a lot of the adjustment. But if the market really believes with high conviction that we're going to continue on a rate cutting cycle, I think it's fair to assume that the dollar would weaken a little bit. I think most people would say over the longer term, they agree that the dollar has been overvalued for a considerable period of time. And I expect that we'll see a little bit more of that adjustment. On balance, though, I think we're going to see.
All right. So just exiting off from Bloomberg TV, just wanted to hear what they were saying over there. But overall, pretty bullish. Wow. You guys got to see this. This is really good. Let me go ahead and share Webull again. Let's go ahead and take a look here. This is beautiful. Let's get Webull to share. So we are still seeing the markets continue to push up, right? So pretty bullish, right? Let me make myself smaller so you guys could see here. Pretty bullish. Let's take a look at Tesla, right? Let's see. The Tesla push up along. Oh, yep. Wow. Yeah, Tesla's pushing up, which is great because Tesla was actually back down in this area that was a bit concerning. Remember, Tesla had broken out of this, this wedge over here, right? And it was having this breakout and then just continued to fall down, which was a bit concerning. We broke down below. But after today's data, or really just the speech from the Jackson Hole Symposium, we're back above this breakout area. So it looks like Tesla's falling along with the momentum of the market as well. One thing we want to keep in mind is that, as we push up, there's less volume relative to price. So it's easier to have those quick moves in the order book. Let's go ahead and zoom out. Now, I still don't believe that Tesla's going to hit new all-time highs just yet. We would need a much stronger catalyst, but definitely good news. We're seeing Tesla push up. Let's see what else is pushing up. Let's take a look at Verizon. Oh, Verizon's falling down. Okay. Let's take a look at HUD. Oops, I clicked Uber. Well, I do have a position on Uber. I do want to disclose that. Let's see. Yeah, no problem. Of course. Thanks for joining. Enjoy your day at work, by the way. But let's go ahead and talk about Uber. Uber is pushing up. Let's see. HUD. What about HUD? HUD is kind of back at this demand area over here. But let's go ahead. I think we're going to go ahead and let's take a look to see if what Yahoo is saying, right? I like to kind of get different perspectives from both. So let's see what Yahoo is saying. Let me remove this. Take a look at Yahoo. I'm going to play it.
At one point, you might see a different reaction in the market, right? Cuts are not necessarily always good.
Yeah, I mean, Brian, is what the Fed chair is laying out in this speech today, is it just stagflation by another name?
Well, yeah, it's stagflation light, right? In terms of, they feel like maybe the balance of risks are such that they do need to respond to the labor market weakness, yet there is that risk of inflation. However, with his view, which I think is a correct view, is that you do have almost this kind of like slow bleed of tariffs into the price level, which shows up as slightly higher and temporary inflation. But the key thing, as long as they can cut and those inflation expectations remain contained, or in today's situation, they signal they're going to cut and inflation expectations remain contained, they can probably take comfort that they can do at least a one-off adjustment. I would expect that maybe what they're going to try to do is a course correction here. So 25 basis points, see how the data shakes out. As long as break evens, other survey-based or more market-based measures of inflation expectations stay contained, then they can cut again in October. So, kind of like dipping their toe in the water here after having been sitting on the sideline or on the shore for a bit.
All right. So, yeah, no, pretty good day. I'm just still watching the S&P 500, still pushing up, by the way, still pushing up. I'm honestly wondering if we're going to hit new all-time highs for today, which would be very beautiful to see, right? I'm sure everyone would be excited to see their portfolio be a bit more green, right, for today, a bit more green. Just taking a look, because where we currently are, right, we're at 640. Oh, well, let's take a look at the SPX, right? Sometimes it's just easier to look at SPX, the index. So we're at basically 6,465. The high was at, okay. So we're not too, we're we could honestly close the day at new all-time highs just off of Jerome Powell saying that they're open to, you know, those rate cuts in September. So we'll continue to monitor the markets. But with that said, no need to do this any longer. I do want to just thank you guys for tuning in, watching. I'm probably gonna re-watch probably the stream or read the notes or what the script, the transcript from what was said just a few times, just as like the woman from Bloomberg said. Honestly, just to kind of parse through the words, see if there was maybe something I missed, right? But from what I understood, right, it just sounds like Jerome Powell is saying, hey, look, we're not making concrete answers that we're going to absolutely cut, but we are saying that we are going to be, you know, more proactive than reactive. That's kind of the message I took from what he said, although, you know, maybe I misread it, right? Maybe I misread it and misinterpreted it. But you know, of course, you still have a few more inflationary gauges before we actually get the rate cuts. Or the updates in monetary policy. So we are going to get a CPI report, right? So we'll continue to monitor that. But with that said, I do want to just thank you guys for tuning in. I was not going to do a live just because, I mean, you probably can't see it, but did micro needling, right? So it's just something that it looks bad now, but in a few weeks, the face is going to look flawless. But I didn't want to go on camera today. But I appreciate you guys for tuning in. Make sure to hit the like button if you haven't done so already. And with that said, I'll see you guys on a separate video. Take care, guys.